All right. Good morning, everybody. Uh, we are going to get started. 11:03 a.m. The entire Del Priore Dweck team of myself, Matthew, Charles, Phil LaRusso, Mike Modica, Jack Silverman, Alyssa Harwell, and Ralph Mizrahi would like to take a moment to thank all of our clients for joining the Zoom. For everyone listening to the replay, we hope you enjoy about the next 20 minutes or so. On these calls, we typically speak to the economy and the market in general. We address past events as well as expectations for what's to come. So as of today, July 9th, it's mostly blue skies. We're coming off the best quarter for US stocks since Q2 of 2020. And it's not the same old story as to why. And what I mean by that is that returns, they're not being led by the Magnificent Seven in this year of 2026. NVIDIA, Microsoft, Apple, Google, Amazon, Facebook, Tesla. It's not them that are leading the market this year. So yes, some of them are still up significantly, but again, there's others out there. We're still dealing with geopolitical concerns and the Federal Reserve's constantly changing narrative. Um, but corporate earnings are driving markets higher. We're starting to see also easing energy headwinds. Okay. And despite the recent tech volatility, the Dow and S&P keep eclipsing new highs. So let's hope that continues as we head into the heart of summer. Um, this morning, we've invited in BlackRock, as we do every year for our first and third quarter market update calls. There's no one better than our keynote speaker today, Eric Muller. Welcome, Eric. Eric is a managing director at BlackRock and lead strategist for their multi-asset strategies and solutions group. Eric's responsible for representing BlackRock's model portfolios to financial advisors and institutions across the country. He received his degree from Villanova University and has been with the firm since 2008. Again, we're thrilled to have you here with us, Eric. A quick note to all of our listeners. As always, we've closed the lines to questions so that we can have our replay approved by our compliance team. In turn, that will be distributed to any of our clientele who may not have been able to join us live today. And all right, without further ado, I hand the floor off to Eric.
Joe, thank you for that introduction. I loved your comments around the markets and what we've seen so far this year. I want to say a big thank you to everybody who's taken time out of your summer to hear a bit from BlackRock, myself, how we're seeing the world, how we've been navigating, what has been a positive yet certainly challenging market environment for a lot of investors. And, as Joe said, maybe most importantly, how we view the world going forward and what opportunities may lie ahead throughout the second half of this year. I'm going to put a little bit of a finer point. I'll share my screen in just a second. But Joe made some really great comments about kind of what we've seen so far in 2026. I'll put a little bit of context around that. So far this year, this is through yesterday, right? The US equity market, if you look at the S&P 500, is up about 10% in 2026. That's coming off the heels of 3 consecutive years, 23, 24, and 25, of really strong double-digit returns. International stocks this year are actually doing a little bit better than that, up about 13%. In particular, emerging markets are up 20. Now, bonds, on the other hand, they're flat. Yields have become more attractive over the last few years, but the returns from the bond side of the portfolio is certainly not as strong as what we've seen on the stock side. And then as I get through the conversation today, I'm going to make a comment, Joe, to your point, the Magnificent Seven, which we've all talked a lot about over the last couple of years, may not be those industry leaders in 2026. But when I look at what has led the market higher, it continues to be the artificial intelligence theme. AI stocks, broadly defined, whether that's semiconductors, memory, chips, et cetera, those companies on average are up 40% this year. So in a market where stocks are up 10, that artificial intelligence theme that was for a long time sort of synonymous with that Magnificent Seven cohort is still the dominant theme in markets. That's still an area where we continue to lean in from an investment perspective in our portfolios. And it's showed really strong results Joe made the comment before about corporate earnings. I'm going to show you a slide later. That continues to be where we see the strongest earnings momentum from a corporate perspective, which of course then drives stock market returns over the long run. Now, that strength in those market returns to start this year is against this backdrop. And Joe, again, you mentioned a few of these things, right? We've had an outbreak of war that caused an energy shock. You've had a new Fed chair and a lot of changes in the transparency or lack thereof, the way the Fed may or may not interpret inflation numbers. Inflation itself is stickier than I think most individuals and certainly investors would like. So it's not been a sanguine market environment. There's been a lot of concern, a lot of reason to be more cautious, and yet we've got this really strong equity market tailwind. The other nuance as I get into sharing my screen is underappreciated throughout the year so far is that dispersion, and I'm going to define that in just a second, but dispersion is at all-time highs. What does that mean? When you look at any given part of the equity market, of the bond market, of really almost any investment category over the course of this year, dispersion is the gap between the winners and losers, the best and worst performers. And that is at all-time highs. So this has been an environment where, yes, you've wanted to get your big asset allocation calls right, but it's actually been an environment where more granularity, a finer tooth comb, really digging into where do you see the best niche opportunities in the market has rewarded investors with that skill. And so I'm going to share with you a little bit of where we've seen that over the last couple of months, what we see as coming over the next couple of months. And Joe, feel free to chime in if I miss anything or you want me to dive into anything more specifically. But if I think about kind of where we've come from, right? This environment of for back-to-back years, major either geopolitical or political uncertainty, rattling markets in the first half. Last year, it was the idea of tariffs and Liberation Day, the impact that would have on inflation and the economy. This year was the outbreak of war with Iran in the Middle East. What this chart is showing you is the importance in those moments of time of staying disciplined, right? Oftentimes, these geopolitical events, I know, Joe, you and I and Matt and others have talked about this on calls like this in years past. Those geopolitical events create a lot of anxiety, rightfully so, for a lot of people, a lot of investors. But from a pure market standpoint, they oftentimes do not have long-lasting impacts on the economy or on the ability for the market to deliver strong returns. And that's exactly what we've seen each of the last 2 years. Just look at the gold line here. In the first quarter of 2026, you had from the bottom, right? You had this near-term kind of 30-day turbulence in the equity market. You saw a bit of a drawdown in stocks. It only took 11 days for the market to recover back to where it was prior to the outbreak of war. So if you're actively trading and you're trying to, cut risk, get defensive in the height of that uncertainty, you very likely missed out on the upside that came immediately thereafter. And so our approach was, as it often is in these moments, with some exceptions, to stay disciplined, to make sure we've got the right diversification and weather that geopolitical uncertainty. Because again, what matters more to us and to many investors is what does the momentum in the economy look like? And let's follow that rather than the headlines around some of these uncertain environments. Now, that does not mean to diminish entirely that there are no risks out in the market. And I think one of the things that led us to want to change a little bit in our minds how much risk we're taking in portfolios, how we're positioning ourselves, was the fact that you did have, to Joe's point earlier, the strongest quarter in the second quarter of this year in many years. The equity market rallied really strongly off of those lows back in March of 2026, and yet the risks hadn't changed, right? There was still this bottleneck in the Strait of Hormuz. There was still the impact of that on shipping lanes and supply chains for companies across the globe. You've had elevated inflation, a big change in the expectation for where yields would be, in the United States over the course of 2026. When we started the year, the market expected that the Fed would cut multiple times. The expectation is now that the Fed may even hike rates before the end of 2026. And so there's been a lot of change, but the market moved significantly higher. And so the question then is why, right? Joe made the comment earlier around earning strength. I'm going to show you that in just a second. That's our answer. The strength in the economy, the strength in corporate earnings is what's been driving markets, not just in 2026, but over the course of the last 3.5 years. But we have to acknowledge that we are not out of the woods with respect to some of these bigger picture macroeconomic risks. And so what do you do when the market is up as strong as it was in the second quarter? You take some profits, you make some reallocations, you think a little bit more deeply about how to best diversify investors' portfolios to help ensure that you can protect some of those gains and make sure that you're able to deliver greater consistency, on a go-forward basis. And so we thought a lot about, okay, if you were to see this geopolitical uncertainty persist, what part of that matters? And ultimately, as we've seen this year, it's about the energy shock, right? The energy shock of elevated oil prices. And what does that mean, if anything, to the health of the overall economy here in the US or outside the US? And so we actually took some guidance. This is a study that was done by Deutsche Bank and Bloomberg. But you actually look at, okay, well, what if we got to a more extreme scenario? What if oil took a next level jump up because tensions escalate further from here, right? Maybe not our base case, but certainly even given recent announcements, not out of the realm of possibility. What would happen? What impact does that have on different parts of an investor's portfolio? And what we're showing you here is we know elevated oil prices, elevated energy prices is inflationary, whether you're here in the US or outside the US. We're showing Europe and China here on the page as well. But the bigger question is, what is the impact on economic growth in these different parts of the world? And when you look at that chart on the right, you see that the impact on the US economy of elevated, even extreme levels of oil prices is significantly less dramatic for the US economy than it is for non-US economies around the globe. The US is more energy independent today. That's a difference from where we were decades ago. And so this is an important consideration for how do you think about, despite the fact that non-US has outperformed on a year-to-date basis, perhaps the US equity market, based upon this analysis and where we see really strong earnings momentum, is actually a slightly, call it safer or more sheltered part of the equity market or economy to invest your capital in an environment where you may get more concerned about some of these inflationary or energy related shocks to the global economy. Now, I want to touch on that earnings point that Joe made, because I think at the end of the day, and anybody who's heard me talk in the past knows that, our investment team, our process, the things we look at, of course, there's a lot there, but the underlying trends and momentum in earnings information, the profitability and the future profitability expectations of individual companies drives a lot of our decision making. It drives how we position regionally. It drives how we think about the best sector opportunities, whether that's technology, industrials, healthcare. It drives a lot of our thematic positioning around AI or defense. And what we've seen in 2026 is a really interesting and powerful phenomenon. I'm going to focus on the chart on the left here, because I think all of us as investors, we may tend to focus on, hey, there's earnings results. We want to see, did Apple beat? Did NVIDIA beat? Did they miss? Is that going to drive markets? What really matters, and especially after the last couple of years, for your stock price to go higher, you've got to beat earnings expectations and you've got to have your future earnings revised higher. That's the second piece that most companies now need for that higher bar of seeing a sharp move higher in their share price. Well, what's happened in 2026? From the start of this year through the end of May, you've seen earnings expectations for next year, 2027, for the S&P 500, the entire equity market, increase by 8%. So the expectation on next year's earnings for US companies is 8% higher today than it was at the start of this year. You look at AI infrastructure companies, again, semiconductors, memory, chips, et cetera. Those earnings expectations for next year have been revised higher by 32%. So when folks ask, hey, why are AI companies continuing to lead the market higher? It's because the earnings expectations for 2027 have increased 4 times larger than the rest of the equity market. So that's where we spend a lot of our time analyzing that information, getting ahead of those trends, and wanting to position portfolios to benefit and earn more of that future earnings potential that's really driving stock market returns over time. So it's been a really strong year. We think this is the main reason why the equity market is up the way that it is. It's why we see certain companies like those around AI infrastructure outperforming the market. It's tied to real fundamental strength in the business models, in the profitability, in the revenue generation coming out of those corporations. That is a healthy market to be investing in, and it's one of the reasons we remain optimistic and positioned, slightly risk on in portfolios here at the midway point of 2026. Now, outside the US, some really interesting things happening. You're seeing I mentioned dispersion earlier, the gap between winners and losers. What this chart is showing you, and I don't anticipate anybody's going to see the words at the bottom of the page, what we're showing is basically every country across the globe and what that country equity market return is so far this year in 2026. You've got South Korea on the left up 73%. You've got Indonesia on the right down 27%. That gap between best and worst is 100%. That means dispersion, right? That gap between winners and losers is creating an opportunity to make investment decisions to capitalize on where you see the right opportunity to invest outside of the United States in certain countries over another. So we see this as something that is likely to persist. In fact, country dispersion, the way that I'm describing it, is actually something of a common phenomenon. And we think that that's the way that we can harness opportunities outside the US. We have a preference to be overweight domestic exposure today, but in non-US markets, we want to get that next level more granular to uncover which markets, which countries, based on earnings results, based on their relevance around themes like AI and supply chain to AI, is going to drive those country equity market returns higher. We can benefit from that in portfolios. Now, I think the biggest challenge for a lot of investors, ourselves included, quite frankly, in the market this year, and this has been true now for several years, is all of us, you all have worked with Joe or Matt or others there on the team to figure out, okay, here's my long-term objective, here's the right kind of diversified portfolio to reach my long-term investment goals and objectives, and everyone's a little bit different, but the concept of diversification, owning stocks, owning bonds, has always been predicated on what you see here on the left. I like to I've got 2 young girls, so I call this the Pac-Man chart, where in the past, pre-pandemic, you had equity markets when they sold off, treasuries or bonds, they performed well, right? So you had this diversification effect. The more you owned fixed income, the more treasuries in your portfolio. When equity markets sold off, that helped to dampen that volatility. It helped to reduce the drawdown. That's the idea of diversification. Now look on the right. We are in a different paradigm the last few years. And this is not, in our view, something that's going to change too dramatically over the next quarters or couple of years ahead. What you see on the right here is both lines moving in the same direction. When equity markets have sold off, bonds have also sold off at the same time. Now, I'm generalizing a little bit. That's unfair to certain parts of the bond market. But I think the idea here is we all have investment goals, objectives. We hope that diversification can help drive more consistency, reduce volatility. Bonds alone, not necessarily delivering that type of protection and ballast and diversification that we've historically wanted to see in diversified asset allocation strategies. And so what can you do, right? Over the last couple of years, there's been moments in time where we've said, energy related exposure like commodities back in 2022 was a nice additional allocation to complement bonds to help better diversify away from stocks. 2 years ago, we said the same about gold. And increasingly, given this gap in dispersion, we think the opportunity set for other kind of alternative or off benchmark positions are important considerations for us to be able to deliver greater diversification, greater consistency, and help combat what you see on this page, which is to me and to our team, probably the biggest challenge for any investor in this environment. We have a strong positive view on the health of the economy. That doesn't mean it's a straight line higher. We're always going to have periods of equity market volatility, of equity market drawdown. We're going to do our best to navigate that at different moments in time. We have tools we can use at our disposal to do that. But one tool that is not as sharp as it used to be is the bonds held in the portfolio. And so, how do we think about opportunities in non-US bond markets, in alternatives, in other maybe precious metal assets over time to combine with bonds to diversify the risks we want to be taking and get rewarded from on the equity side or on the stock side of portfolios? So, that to us is one of the biggest things I think to focus on in the years ahead. The good news is you've got a great team there working with you day to day. This is something we care about all day long. And so those are adjustments that we are focused on. But I think it's important for us all to understand that dynamic between the stock and bond relationship that we've been accustomed to for many, many years. One day may return, but right now it's a little bit challenged. And so let's bring more tools into that toolkit as appropriate to be able to better deliver diversification and consistency over time. So if I think about just how we are positioning strategies off of those views, we are risk on. We prefer stocks over bonds, right? We think that outperformance of stocks relative to bonds that we've seen so far this year will continue. We have a preference for the US over international. You've heard me say that earlier in the conversation. Duration just means how much interest rate sensitivity do we want in the portfolio. Given a lot of the uncertainty on the bond side of portfolios, we're underweight interest rate risk, we're underweight credit risk, not because we think there's issues with defaults in the economy, but spreads or the compensation, the return you're getting in higher risk fixed income is just not worth the risk that you're taking there. And so we'd rather own a little bit more in stocks, take some risk off the table on the bond side of portfolios, and we think that's a better way to navigate the market environment that we find ourselves in here today. Joe, I'm going to pause there. Hopefully that was a helpful overview of kind of what we've seen, where we see things going. Anything I didn't mention, any questions that you have, Joe, that you wanted me to dive into?
No, you went through exactly what we were hoping for today. I am receiving the question over and over of I have my high yield savings account. It's my buddy. It's getting me still over 3%. And my answer to that has been drip into the market. Continue dollar cost averaging. You're doing that with your 401ks naturally. Keep doing it, with your dollars outside. My retirees, what can I do? What can I, listen, it's a conversation that we can have and that we love to have. Reach out to us, get us, on the calendar, and we can discuss options with you. Thank you for your time, Eric. Appreciate it. Thank you for everybody that joined today. There will be a replay that will be spun around within the next couple weeks, and enjoy your summers.
Thanks, Joe. Thank you, everybody. Enjoy your summer.
All right, bye bye.